The pitfalls of investing in American companies with Chinese production, a risky proposition. Introduction. In the interconnected global economy, investing in the stock market has become a popular way to grow one's wealth. However, not all investment opportunities are created equal. One particular area of concern is investing in American companies that have production operations in China. While the allure of lower production costs and access to a vast consumer market might seem tempting, there are numerous reasons why this may not be a prudent investment strategy. This article delves into the potential pitfalls of buying shares of American companies with production operations in China. 1. Geopolitical risks. Geopolitical tensions between the United States and China have been well documented in recent years. Trade disputes, intellectual property theft, and concerns about supply chain dependencies have strained the relationship between these two global economic powers. As an investor, putting your money into companies with operations in China exposes your investment to the uncertainties arising from these geopolitical dynamics. Changes in trade policies, tariffs, or sanctions could significantly impact the company's profitability and, in turn, its stock performance. 2. Regulatory challenges. China's regulatory environment can be complex and unpredictable for foreign businesses. The Chinese government has a history of imposing sudden regulatory changes that can impact various industries. Recent instances include crackdowns on technology companies and stringent data security regulations. Companies operating in China are subject to the authority of the Chinese Communist Party, which can lead to unpredictable shifts in the business landscape. Investors could find themselves grappling with unexpected legal and compliance challenges that adversely affect their investments. 3. Supply chain disruptions. Investing in American companies with Chinese production ties your investment's fate to the resilience of China's supply chain. The COVID-19 pandemic highlighted the vulnerability of global supply chains, and disruptions caused by factors like factory closures, transportation limitations, and export restrictions can severely impact production and distribution. A single disruption can lead to stock price volatility and diminished shareholder value. 4. Intellectual property concerns. Intellectual property theft has long been a concern for foreign businesses operating in China. Companies are often required to share their proprietary technology and information with local partners, which can result in the unauthorized use or replication of valuable intellectual property. This not only weakens the competitive advantage of the investing company, but also raises questions about the long-term sustainability of the investment. 5. Ethical and environmental considerations. Investors today are increasingly conscious of ethical and environmental considerations. Companies operating in China might face scrutiny for their labor practices, environmental impact, and adherence to human rights standards. Aligning your investment portfolio with companies that uphold responsible business practices can be challenging when dealing with operations in countries that don't share the same standards. 6. Currency risks. Investing in companies with Chinese operations exposes you to currency risks. Fluctuations in the exchange rate between the US dollar and the Chinese yuan can impact the value of your investment. These fluctuations can be particularly pronounced in times of economic uncertainty, leading to potential losses for investors. Conclusion. While investing in American companies with production operations in China might appear promising on the surface, the complexities and risks associated with such investments are significant. Geopolitical tensions, regulatory challenges, supply chain vulnerabilities, intellectual property concerns, ethical considerations, and currency risks all contribute to an investment landscape that is fraught with uncertainties. As an investor, it's crucial to carefully weigh the potential rewards against these numerous risks before deciding to buy shares of such companies. Diversification across industries and geographies remains a prudent strategy to mitigate these risks and ensure a more balanced and resilient investment portfolio.